All right, like I said, this is going to be recorded. One thing I say at the beginning of all of these webinars is please watch it again as soon as you get this sent to you, because some of these things I'm talking about will go right over your head the first time. Second time through, you'll pick it up and you'll remember it a lot better if you watch it again relatively soon after watching it the first time. First time through, it goes to your short-term memory. Second time through, kind of sticks into your long-term memory watching it. So I highly suggest doing that rather than waiting a few weeks, because then some of the thought or the theory behind it will be lost and you'll be relearning it again. Anyway, this is going to be a call option strategies for earnings season. Now, I thought about throwing the puts and the calls into this, but it just got a little bit long, and I thought it would be a little bit confusing if you were a newer trader. But it's also getting ready for earnings season. Some people are saying, well, we just had earnings season. Well, it's important to do this right now, and I'll explain why in a little bit. But gearing up for earnings season, you can throw a couple of trades on right now and get ahead of volatility expansion is really the idea. Anyway, a little about myself. My name's Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. And I've been trading my own money for well over 20 years now. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to teach you how to take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. I always talk about this as well. You know, if you have a financial advisor out there doing it, the fees the financial advisor is charging you, the fees on the no load, quote unquote, mutual funds and things of that nature, there is a lot of fees in there. And there was just an article out that 25% of all billionaires in the United States are in the financial services sector. So that's where your money is going. Anyway, so you might as well pay yourself some of that money and learn to do it on your own. So that will increase your yield on your returns. So if you're not paying all those fees to anyone else. Anyway, I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodities, and currencies, and options on all of those contracts in all market conditions, as you can see down here. Got to go over a little bit of a disclaimer here. It's basically any opinions, news, research, prices, and other information contained here are provided by Pro Trader Strategies, associate companies, or employees, is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Now, I got to say that, you guys, because at the end of the day, I can't give a recommendation, a blanket recommendation on any stock or strategy, because I don't know your each individual risk parameters, and I don't know what's in your portfolio. So what I could be talking about on a specific stock or underlying could be counterintuitive to what you are doing. And the other thing is, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. The final thing is I may be talking about stocks or option strategies that I already have in my portfolio. I'm not trying to get you guys lemming off the cliff. I'm trying to just teach you guys and give you examples of what I'm doing so that you can better understand how to implement something like that into your own portfolio. Anyway, like I said, this is earnings calendars, and it's basically a long horizontal spread. So we're going to be selling an at the money or just out of the money call nearest the expiration, at the nearest expiration, and then buying the at the money or just out of the money call that has that earnings in that expiration cycle. So it could end up falling on a weekly, which is most of the time that happens. So we're going to need to have a couple of things fall into place for all of this to work out. One thing we do want with this call horizontal spread is we do want a directional assumption, and the directional assumption, because we're short one in the front, we're long one in the back, we kind of want this market to really go down a little bit and then have that front month expire worthless and then rally in the back end towards that earnings cycle. Doesn't always happen that way, but I put on a couple of these earnings trades already, and despite the fact that I've gone into the money, I'll show you how some of the deltas will work where that back month is affected a little bit more than the front month, and you'll still be positive even if you go into the money because you're picking the same strikes. But we want low implied volatility percent when entering this trade. That, usually when I'm talking about selling strategies, we're looking at something above 50% IV. This one, I'm going to be looking at nothing above 30, and I'm going to try, and there's plenty of them right now that are in the teens. So somewhere below 20-ish is plenty of stocks out there to look at for this. But that's the wheelhouse. You want like in the teens at bat, or somewhere right around the teens for the best case scenario. So like I mentioned, we want high open interest in that options cycle or in that underlying. It doesn't have to necessarily be a lot of open interest in the strike that we're picking, but in that underlying, there needs to be a lot of open interest in and around those different options expiration cycles. So we want that to happen because there's a lot of participants in that market then. So they're going to be always looking to lay off some risk here and there. So there'll be people in there as long as that underlying has a lot of players, if you will, is what we would call it on the floor. What we want to happen is have obviously our directional assumption be correct. We definitely want this to go, follow our mindset on this, that sell off in the beginning and then rally in the end. Doesn't always happen, and we can still be profitable if it doesn't work out, but we definitely would love to see that happen. That would be having everything work out swimmingly, I guess, if you will. And we want that volatility to expand. Volatility isn't going to contract around an earnings or a binary event. Binary event is just a known event that is down the road that will affect that underlying. So earnings always expand the volatility. And best case scenario is we're able to cover this for a profit before that binary event, right before earnings comes out. We want to be able to cover this and not have any risk on anymore. So that would be the best thing for us. Another thing I didn't add to this, and it just kind of popped into my head, is we want that directional assumption in the beginning to go down. So we want this underlying to slightly go down or just trade sideways at best. And that way it allows us to roll those short calls a couple of times towards that binary event and collect some more premium. So that would be the best case scenario as well. All right, so let's go over the max profit, max loss, and the break evens. Anytime you are paying a debit for any option strategy, you have unlimited profit. Okay, if you're buying a put, it's considered unlimited profit, but we all know it can only go to zero. But in this case, we're talking calls, so obviously any stock can go to the moon. Max loss is going to be that premium paid. So that is going to be the most we can lose on this. Now remember, we're short a call in the front month, and that will expire before our long call. So that's part of the profit potential also, but our premium paid is that max we can lose on that long call. And if the market rallies against us, we're short a call and long a call, and they basically offset. So that's how your max loss is the premium that you paid. The break evens where it gets a little bit convoluted, I guess, if you will, because the break even is that long call plus the premium we paid. So if we bought a long call, say at the 100 strike, and we paid, or we're doing this calendar, I should say, with the 100 strike. So we did the Aprils and the Mays, just for sake of argument, and we did the 100 calls. Let's say we ended up paying 71 cents. That means our break even is when that underlying is trading at 171 cents. Does that make sense to everybody? Where it gets a little bit iffy is if volatility starts to expand. Volatility is going to affect that further duration contract. So as the volatility increases, that premium in the back month is going to inflate faster than the front month, okay? So in a sense, our break even will lower, because if we say, for instance, paid 71 cents for that 100 call calendar and volatility starts to expand, that back month gets affected more. Now it's at 81 cents. Then our break even is a little bit lower than that $1.80 or $1.71 because we're more profitable. It's a little bit confusing there, but just go with the worst break even that you can have is basically the premium you paid added to that long option. But it can fluctuate based on volatility expanding. Does that make sense for everybody so far? All right, good. All right, so let's get into the, everybody's looks to be pretty happy today with a 200 plus point rally in the Dow and 30 some odd ticks in the S&Ps. All right, so let's look at a couple of, and please, during this segment of the webinar, please throw out stocks that you want to look at for your earnings, your earnings picks, and we'll see if it falls into the right category. I mean, I've been known to pick some of your guys' picks as well. So my first thing is to go to the watch list, and I have high implied volatility percent right here, which is the same thing as down here, except it goes into more detail. It's more of a decimal here. This is a rounding thing where it just rounds it up. So for instance, we're getting a bunch of them right now. So let's look at, for one, Netflix, or here, let's go Amazon. I haven't looked at Amazon in quite a while. Somebody's throwing out Amazon. Amazon's down there below that. I would like, I would like to see it in these teens for best case scenario, but for this one, we can look at it. One thing that I like to also try to do here is when building this, I don't want to do this for any more than $1 debit. That's one of my own little side rules, is that's my gauge to try and do that. Now, one thing you can do is, without even knowing where the earnings cycle is, can anybody figure out where they think the earnings cycle is based upon these numbers here? Where the earnings land exactly? Right here on these April contracts, I'm betting, because look at the volatility. Slowly creeps up, but then we have a big jump right here in this April expiration with 42 days. And then the day after, or the cycle after, drops off by 5 points, right? It starts going back up again. There's probably another earnings in there too. But we're going to be looking at this specific month, the April 42s. And we can probably go to the chart and find that out, that there's the earnings on the 21st, which falls right after the monthly expiration. So right after that, so that's the one we're going to be looking to buy. So that's the one we first go to. So we look for that. Then I usually like to go to about, I want there to still be enough premium in these contracts. There's not going to be very much premium left in these, for instance. It still has a lot because it's Amazon. It's $500 stock, or $550 stock. But the next thing we're going to be doing is looking at right here in the 30-ish deltas. Depending on how bullish or bearish you are, like if you think that Amazon's going to go straight up now until earnings, then you're probably going to want to pick a little further away, okay? to give that time to decay on these. If you get too close and you think it's going to keep rallying, you're just going to go straight into the money. Now this is what I was talking about, the difference in deltas and how they're going to be affected. The ones that are further in time away are going to react a little bit more to the underlying. So for if you're picking a 37 delta in this month, for every dollar move in this underlying, it's going to move, this premium is going to move 37 cents. This one, for instance, which is, let's just pick the 88s, just make it easy, make sure they have it. Oh, they have it. So the 577.50 are 37 deltas. Down here, they are 48 deltas. So you're getting an extra 11 cents on an upward move with these than you are with these. So even though the market's moving against your short calls, remember that until they start going deep into the money, that these are going to be working for you. So I usually like to try and pick, somewhere in the 30s, maybe even right in here. So that's what I would look at. I'd also like to check the charts just to see where the 580s are. Probably right around in there. So it's has covered that. Yeah. So that looks like a pretty good area, 580s to sell, because it's going to find some kind of resistance up in there. You can also, I don't know if you like to do the Fibonacci's, but I'll just do this real quick. And my Fibonacci's not on. All right, it says it's on. So go to the Fibonacci just to double check yourself. See if there's a 580 in there. It doesn't really come up. 570-ish. So anyway, that didn't help anything, but we can still look at it for this. But so then you would want to sell the front month. Okay, that pulls up the sell. And then we're going to try and pick this. We're going to pick the same strike. 580s, that's way too much to do that. So you'd probably have to go somewhere else. Oh, because that's the 7 days. So I'd probably look to do maybe the 21 days and see what those are. So you're paying a lot of money for this one because it's such a high price stock. So that wouldn't really fit for me just to tie up that much capital for that long. So I'm going to pass on Amazon, which I kind of had a feeling. But so let's look at, is this a strangle spread? No, this is, it's called a horizontal spread. It is similar to the straddle, if you will. It really isn't. I shouldn't say that. It is not, because a straddle is a put and a call. We're just doing calls on this. We're going to sell the front month call and buy a back month call. So legitimately, it's a horizontal spread is what it is. Because in a vertical spread, you're like a vertical call spread, you're selling the call here and buying a call here, or you're doing it the other way around where you're buying a call and selling a call. That's horizontal, or sorry, vertical, because you're vertical up and down within the same month. Horizontal is the thought that you're moving sideways down the calendar, right? So it's a call, yes, it's a call calendar horizontal, or a call calendar or a horizontal spread. That makes sense. So so let's look at a couple of the other ones you guys were looking at. Netflix. I do have something in Netflix, I believe. So I want to delete this. So I want to get out because 7 days is not going to give me any money. The thing I really like to do is, we want to take advantage of this theta decay, and the theta decay happens best within this 28-day area. So, I'm kind of shooting for somewhere right around in here for my short strike so that I get a lot of theta decay rather quickly. I don't want to go too far out in time. And if I go too far out in time, it's not going to give me the opportunity to roll usually either. This strategy will involve margin, yes, but it is usually like right around what you're risking, so it's not that bad because your short is really covered by the long duration, long call. And I'll even show you guys that on when we start looking at it. So so anyway, so let's look at Netflix earnings cycle. You can close these down just to figure it out rather quickly by looking right over here. So we'll look at Netflix and try and figure it out. When it starts spiking, it spikes the most right here, and then as you can see, it really falls off the bed right here. So Netflix has pretty high implied volatility yet, so I'd probably stay away from that, only because I can see this entire list of low implied volatility. I mean, there's plenty to pick from over here. So if you guys have been watching the daily market commentaries, I did one in Johnson & Johnson where I sold the April 1s and the April monthlies, or sold the April 1s to buy the April monthlies for 43-cent debit. And you know, that's they did the 43 calls and did it for a 43-cent debit. And then the Pepsi, I also did the April 1 option cycle, which is this one right here, and the April 4 cycle, which is just afterwards. I did the 100 calls for 71 cents. So I sold the April 1s, bought the April 4s on that. So those are two that I had done earlier this week. But let's move on to some new ones that I think that are pretty good ones. Like this Disney. I mean, everybody loves Disney. Everybody trades Disney, I guess. So that seems like a good one to be a little bit bullish. So let's check out Disney. Oops. So Disney, as you can see, 14%. It just rounds it up. So that's low. The other thing that you can look at on this is you can see how much volatility contracts afterwards. That's what we're trying to take advantage of. And look, if you did this after the earnings the last time, you can see volatility pretty evenly expands. It gets a little gyrated in there, of course, but it continues to expand all the way to the earnings. So it went from after the earnings down here in the 27s all the way up to 77. So 50% or 50 percentage point increase from one cycle to the next. So that's really what we're looking for, is that rather big rally up into earnings. So now we're really low here. So we could safely assume it should at least go up by, you know, another 50 percentage points to the 60s at least, which is going to make those premiums in that month that you're buying really inflate. Even if you're directionally wrong, it could still keep you profitable as that volatility increases. That's really what we're looking for, to help mitigate some of our risk there, so we can be directionally wrong and still possibly make money. Doesn't always happen, but it does happen. So Disney looks good for me anyway, I would think. And, you know, it's been beaten up pretty much after all this Star Wars hype. So we can look here also and see that didn't really, let's look and see when the earnings is. It comes in after that April cycle on the 5/3. So we can figure, looks like it's right there is my guess. So that would fall there, 42 days, pretty sure. And then look around this 21 days seems to be the ones that is right there in that wheelhouse. You could go to the 28-day if you wanted to, get a little more premium. We can check it out, see if we get $1 for this first. So we're going to look at this 30-ish delta, depending on how bullish or bearish you are. We can look at the 36 delta, and then that's 99.5. Yeah, they do still have that as part of the Oh, I don't know why I didn't pull up. So sell that and then hit the control. So we're selling, oh, this went backwards. So we're selling the April 1s with 21 days to go. And then we're buying the April 4s with 42 days to go. And we're collecting less than, or we're paying out less than $1. So that's good. That meets all the criteria there. And you don't want to do these with a lot because you're tying up for a while that you're going to be watching this. I usually do them a little bit less. This is more for engagement for me. And why do we eliminate Amazon again? Amazon had pretty high implied volatility versus the rest of these. I was paying out a lot of money. I like to pay out like, $1 if I can, less than $1 at bet, or for the best case scenario, and it wasn't looking like I was going to be able to do that. That's why I just nixed it. Had a little bit too high implied volatility versus, I mean, there's just a plethora of these, so that's why I kind of backed out of it. And this one, you're paying 80 cents for it, so that's working out pretty good. Are you looking at IV percent or IV when setting up the calendar? I'm looking at the IV percent, which is right down here on toss, think or swim. It's right down here, and you can go into the gear and customize it and add IV percent to your watch list also, which is what I do. Yeah, and so the cells, let me get rid of this. So, because this punched it up backwards because I didn't hit it. Okay, so going over how we set this up. First off, we're looking to see where the earnings are falling. For some reason, that implied volatility is higher now all of a sudden. And I know it doesn't fall in that April cycle because it falls on the 5th or on the 5th. So that probably isn't even this April. It's probably closer to the May. Because that April is going to be gone. So we're going to be doing the May. If you do the math real quick on the expiration dates. So the 5th. Yeah, so I think the best one is going to be this one for the example. So this gives us several cycles to roll out and collect more premium on this. The question being asked, what IV range are you looking to use to set up this type of calendar for earnings? I'd like to stay below 20. If I find a really good stock, I'll push that up a little bit. But, in this environment that we have right now with all of this really low implied volatility percent on all of these big name stocks, you got Pepsi, McDonald's up there, Southwest Airlines, UPS, Microsoft, I mean, United Airlines, Apple, American Airlines, Monsanto. So you got a lot of big Facebooks even in there. We'll look at one for Facebook too, because a lot of people like to trade Facebook. So I'd like to stay below 20 if I can. When IV is really high, it makes it a little bit difficult, or if I find something, but I'd like to try to stay below 20 because that gives me the opportunity to, the more volatility inflates for me, the better off this strategy is. If it only inflates a little bit, then theta decay and stuff like that are going to be negatively affecting us. We want this volatility to start ramping up pretty soon. And this is about the time frame where volatility on these stocks starts ramping up going into those earnings cycles. So it's imperative to take advantage of that. So with this, we're going to be looking at Disney and trying to get $1 for that, or pay less than $1 for this. So if we're doing the 100s, it looks like we're going to be able to do it. No, it's not, because it's too far away. So the 105s is not going to give us anything. So the 100s, you're going to be paying out $2 for it. So I don't really like that one either. Because I'd like, I'll mark that down. If I can find something better than $2, then I'll probably just go with those. Like I did with the Pepsi and the Johnson & Johnson. I only paid 71 cents and 43 cents for those. So let's look at Apple, see if we can get it a little bit tighter. I haven't looked at Apple yet. And I do have a position in Apple too. So with Apple, we're going to be trying to find the earnings in here by just looking at the implied volatility, and it looks to me like it's going to fall right here in the May cycle as well. You can just double check it by going out here and looking at this. So I would think that it would fall in that last April monthly just by looking at it without doing the math. 50 days out. So with this, I'm going to go with the monthlies just because I know that there's going to be a lot of open interest in there. So let's look at the 28 days we'll go because we're going a little further out. Gives us a couple times to roll it. So I'm going to be looking at this 30 delta. So the 105s. The 105 still going to be paying $2. So that might be about the best we get to do. It's paying about $2 for this. All right, let's look at another one. Let's look at Microsoft. So Apple and Disney, we're paying a little bit more than I would like to see. So let's move on. So these are the steps that I go through. I don't just go and pick the first thing that pops up. I try and go and find the best opportunity by looking at a lot of different underlyings before I choose it. You don't have to pick it right away, today or tomorrow or Monday or for that matter. What is the delta range? I start with the 36 delta, and depending on if I am more bearish in the short term, then I'll go closer to at the money, maybe the 40 deltas. But if I'm a little bit more bullish right now, then I'll be shying away from that 36 delta and go to like the 32, 33-ish area. So, but I try and stay within the 30s. But if I'm more bearish, then I will pick the 40s. Does that make sense? On the delta range. I only pick the delta for the front, the one that I'm selling, and then correlate it to the back. I don't worry about the delta in the back because I know that that one's going to be a little higher, but I try and pick the 30-ish delta in the front and then pick the same strike further in duration. Does that make sense? This is the earnings count, or this is earnings calendars. So we figure the earnings is landing right here on the 70. That's probably the best for Apple. And as you can tell, I mean, I probably don't even need to show you guys this, but if you look at open interest and volume in here, you can see that far out, there's a lot of open interest and volume, and that's why you're getting such a tight bid ask on Microsoft. So Microsoft, we're saying earnings is probably going to land in this May area. We can look here. It's landing on the 21st. So the 21st, I think, should be able to land here. But I haven't thought I did the math first. But in the front, the expiration, I'm looking at somewhere right around this 21, 28 days again. So let's go with the 28 days, just because I think I'm going to be able to get a little bit more money for them. You know, a couple extra pennies here. Look at our deltas. So our deltas 38 is a little close. It's only $1 away, really. So I'd probably opt to go with this 31 delta. 50. Do we have half ticks down there? Yeah, we do. So this one will work out pretty good because we're looking at the 54 and a halves. So I want to sell the front month. And the reason why it's called a long call calendar spread is because we're paying more for it in the back. And we're going to do the 54 and a halves right here. So we should be able to get that for less than $1. Even at the natural being 88, we should be able to get this for that amount. And then so then you can do the confirm and see that your buying power effect is only going to be reduced by $79, and that's the premium that you paid. $79. If you have to ratchet it up, obviously your buying power is going to be affected by what you paid on the margin. This is being recorded, yes, and please go back and rewatch it again, you guys, when you get a chance to. So I think that this is a really good one. You know, one thing you can always check. I do look at the charts. I don't live and die by them though, but I do like to get a little bit of confirmation. I mean, this obviously looks like it's a support resistance area for Microsoft. I mean, it popped up and tested it on the way down, and then when it blew through, it's come back and started finding a bit of a nice little rhythm here. This right here is just showing where volume and time has been spent on this trade. So you can see that right here at the 54 area, there's been a lot of time and volume there, but the predominant amount, which this just indicates where time and volume is, it's just where people have found value for this particular underlying. But obviously things have changed since they came out with much better than expected earnings and caused that spike. So now conceivably it could just run sideways like it did here, but up here. And you can see that it's building a value area here. So I think that this is a good sign for this market moving up. It also is going to want to build out this a little bit more here. So I think this is a really good trade for that. So I'm going to write that down because this is one that I'm going to put on Monday, and that's the April 2 54 and a halves and the April 5s to capture that. So this will be one that I'll talk about in the market commentary on Monday. So if you guys don't watch those, I talk about all these different things. You know, Draghi was speaking. I talked about what they did and stuff like that. So I talk about economic, geopolitical, and market analysis on those too, and the trades that I've done. So please, good afternoon to you too. So I talk about all this stuff and what I'm thinking when I'm going through that, like with the Pepsi trade or the Johnson & Johnson, you know, I kind of walked through that, what I was thinking with that. If we look at the chart of Johnson & Johnson, it's kind of this very similar to this with it being at an all-time high. I'm looking at this call spread, or I don't know if it's an all-time high, but at least 52-week, looking for this to come back a little bit. You know, it kind of settled down, it came up, and I was just looking for it to come back a little bit, kind of gravitate towards this and then maybe repel off of it. So that's why I was short the front month, thinking it was getting a little overextended, topping out a little bit. And hoping for a little pullback before we get into earnings and start seeing that rally. So just a little bit of down and up. It's continued to go up, but it's still a profitable trade. I put it on for 71 cents, and I think it was trading like right around 70 cents. Sorry, 43 cents I put it on for. And yeah, put it on for 43 cents. For some reason, my notes are wrong here. Yeah, I did the 110 calls. Sorry, I said the 43 calls because I wrote, but I did the 110 calls on Johnson & Johnson, so I'm thinking it's going to come back. The Pepsi is the one that's kind of gone against me a little bit, but still profitable. All right, how far out can you trade the weeklies? Great question, Judy. Some of the lesser volumed, like this has 7,700,000 volume. So these are going to have a lot of the weeklies in there. if you look at something like, let's just, I don't know offhand if Love has it. They have all the weeklies there too. So some of them just won't have it, like maybe UPS. UPS has got pretty much all of them too, but there are some of them that don't have all of these weeklies out there. And you'll start getting them when like March goes off, you'll start getting a next, the weekly cycles in there. Trevor's asking, what % of profit are you looking for on this trade? With this trade, anytime I'm long a call and I paid a debit for it, or long, anytime I paid a debit for something, I don't always have an exact profit target because it can really work fast. You know, I want to be profit. If I am profitable on this trade going into earnings, I'm going to probably cover that before the event because I don't want to risk it. If I am, you know, if I am out of the money on my calls, then I'm going to let it ride through that event and then cover it right after usually. But I don't have an exact profit target for this. But ballparking, usually what I do look for is 2 to 3 times the debit that I paid. So if I paid $1, then I would be looking to get $3 for it. So, you know, and make $2 on it. So I usually look for debit spreads 2 to 3 times that. That's kind of my my goal, if you will. Does that make sense for you? Does that answer the question there? If I'm profitable before the earnings event, I'm going to take it off. I don't care if it's just even a couple of pennies. I'm going to take it off. If I am, you know, out of the money, then I'm going to leave it on and let it ride. It's just kind of how I work. And if I'm all of a sudden that front month expires, worthless, and I get a big rally right away for some reason, something comes out, somebody talks, and I get a big rally, and I'm, you know, 3 times what I paid for it, then I'm probably going to cover that too and not even go into the earnings. So that's kind of the way I play that. If I get a real quick rally right after, then I'm going to cover it and take my money and run. Does that make sense? Okay, great question. What happens if the stock moves considerably right away? For instance, you know, you put this trade on and it immediately starts going, and you're deep in the money. Say you're in the money right here, and you only have, let's use this as an example, because 7 days, I wouldn't want this short on and being in the money because of, you know, having somebody put this to me. But say, for instance, you're in there, there's only 17 cents left in it, extrinsic value. Intrinsic's what it's worth. It's worth $3, right? But there's only 15 cents left in it. So that means there's $3 of intrinsic value, which if you just add $3 to 98, that's 101, right? So it's right about 101. So there's about 15, 20 cents in extrinsic value. Now, for that to decay is really hard. It takes, the closer you get to expiration, and these just don't decay that fast anymore. You know, you can see even from 98 to 94, it only decayed by about 7 cents or 10 cents even. So it's not worth that risk for me. What I would, you know, on having somebody put this stock to me, then I would then roll that out immediately. And if I was that deep in the money, I would roll it out to like 21 days to go, right? And then for that same strike that I was talking about, I was saying the 98s, right? So then I would roll out these 98s, and look, I can capture another 50 cents. So I'd sell those for 17 cents, buy these back for, you know, or buy those back for 17 cents, sell these for another 60 cents. So, you know, you're getting an extra 40 cents to this strategy. You're collecting another 40 cents. It's still in the money, yes, but you can still collect that premium and continue to roll it out to collect that extrinsic value. So even if it's in the money, you can continue to do that. And then, you know, obviously you don't want to do it right up until the binary event, but you have several opportunities to do that throughout. Let the long call ride after the earnings. Trevor, if I am unprofitable on this position going into the earnings, then I would let it ride. I would, because you got nothing to lose, right? But if I'm profitable going into that binary event, you have your profit to lose. And this is all about your risk management, right? So if you're profitable, you don't want to let a profit go into a loser, if at all possible. It happens, but we don't want it to happen. If we can avoid it, we want to avoid it. So in that case, if I was profitable going into that event, I would likely close it out for a profit. If I'm not profitable, then I really have nothing to lose, right? If I'm already losing money on it, then I might as well let it ride and see how the cards fall, you know. Does that make sense? All right, so I'm just doing the calls part today. I thought about doing the calls and the puts, but it was getting a little bit long and I knew that it could get a little confusing. So I'm going to do one on puts next week as well. So we'll tie it all together. And Judy's asking about how you roll out. So basically all you're doing is if you are short this, say 98 calls, you would just buy it back, okay? And then you would go to these 90 calls and sell it as one click, or really 2 clicks, because you gotta buy this back. You gotta hold down the control and sell the 98s down here, and then confirm it. And it's going to come out where you have about 40 cents in extrinsic value that you can take away from that debit you paid. So if you paid a debit of $1 originally and you roll it out for this 60 cents, remember you paid the 20 up here, you're selling this one for 60, so your net is 40 cents. You have just lowered your cost basis. So it originally cost you $1, now it only costs you 60 cents for this, because you add this 40 cents back into that debit, because this is a credit of 40 cents, add that into the debit, you have 60 cents. Does that make sense, Judy, on how you roll out and why you would roll out? And as a matter of fact, even if I'm out of the money on this, if this stock was out of the money with just 7 days to go again, you can still, I would still roll it out too. So, what if we did the 105s earlier on and now it's only worth, 5 cents? There's no sense in holding that on for another 7 days for 5 cents, or even 10 cents for that matter. I would buy these back in and roll those out, which are the 104s. So let's just say the 105s, because they are more prevalent probably, the 105s, and then I'd sell these for another 20 cents or so. So you're just going to keep rolling it out, collecting a couple more pennies as you go. Hopefully you can get at least 20 some cents for it. And then, you might go out to this month to collect a little bit more right away. Just skip that month. But trying to collect, a nice little extra. You don't want to do it for another 10 cents. So as soon as it's trading for like 10 cents or something like that, I'm not going to risk it anymore. If it happened right away, I'd roll it immediately. As soon as I got down to 10 cents, that's when I'm going to look to roll. Because there's just no sense, and if even these right here, there's no sense in really holding on to these for another 15 cents for another 10 days or something, if you're lucky enough to. It's better just to roll it out, collect more premium, add some time to it, and keep doing that. One-click roll. If your brokerage account doesn't allow a one-click roll, you have to close the existing and place the ROL as a separate charge. Still pay to roll. I would think, yeah, I mean, because you're still paying the commissions either way. It's not, you're not getting a break on the commissions. I think with Tosh, you get a break if it's below 5 cents, but I'm probably going to roll before I'm at 5 cents too. So I'm likely going to roll it at like when it's only worth 15 or 10 cents. That's probably when I'm going to look to roll. Does that make sense there, you guys? Richard's asking, do you have to use margin with this strategy? The margin is the debit you paid. Like with any options, your risk is the debit you paid, and with this strategy, it's the same. It is the debit you paid. Because you're short in the front month, you're long in the back month, so they're offsetting until that front month expires, or you just let it expire or get rid of it, you trade out of it and let that back one ride. There's no risk then anymore to the clearing firm, because you are long an option. You have the right but not the obligation to exercise that contract. Whereas when you're short an option, you have unlimited risk. And so does the clearing firm. That's why they do the margins on that. But when you're paying a debit, your margin is really just the debit you paid. Does that make sense? Oh, some don't have a roll function. Can you not, with some platforms, just go in and hit, like, if I wanted to buy this, and then you just hold down the control button and then hit sell on the 102s, then do something like that, where you hold down the control button and then just click on it? Oh. Go to TD Ameritrade. Tell them Wolfman sent you. I don't know. I've only really used this in Cunningham from the floor. Cunningham had even a roll function on that too, so that's surprising. I don't know. I can't speak on that, then I'm sorry. But then in that regard, yeah, you would just buy it and then come in separate transaction and sell it. You're not saving any money by doing the roll as one click. It's just a little less hassle, and I think you can see it. Some retirement accounts don't have it, the IRAs. Are you a Schwab or something like that? All right. I don't know. I don't know how to approach that, because I haven't used those platforms, so I don't know if there's a way around it. I got a tricky way around it. Like with this one, I don't have to go up here and hit like vertical spread or hit, you have all of these. I almost never do these. I always like build it out myself, even though just because they don't usually have this, don't pick the strikes that I want to, so I end up having to manually go around and rearrange them, so it's almost as easier. But this would be the calendar spread that you would do. But see, they're just doing March to March, so anytime you would do that, you'd have to go in and switch those months. So I just stay away from it, stick with the single. You're asking, does it, for calendars, does it really matter whether you do calls versus puts? Only in your directional assumption. So if you're bullish, you would not want to really do the puts, right? Because you're going to be long puts in the back month which is directionally to the downside. So whatever you're doing in the further duration is really your assumption on the direction of the underlying. So if I'm long calls, my direction on the underlying is biased to the upside. If I'm long puts in the further duration, my long-term bias perspective is to the downside. So I have a downside assumption. Does that make sense, Mike? So yes, it does. It only matters in, if you have a directional assumption. If you don't, the puts generally are going to give you more of a credit or more credit or have higher inflated premiums. But that's the only real difference there other than your directional assumption. So with this, you do need to have somewhat of a directional assumption. If you are overall really long in your portfolio, that would be another time, even though you're bullish, but your overall portfolio is really long, this is a nice little way to add some downside to your portfolio and neutralize some of your exposure to the market. For instance, I've been doing some of these, I've probably been looking at doing these calendars a little bit more because I'm overall bearish right now. I don't really know what my assumption is going to be 70 days down the road, but right now I'm pretty bearish just because I don't see the overall economy doing that great. So this fits perfectly with my whole thinking of how the markets are working. Clearly they aren't working for me, but that is my assumption, and I've got to stick. That's the way I feel, so that's the way I'm playing it. That's another reason why I say don't just do what I do, because you guys might even have a completely different perspective of what the market is doing. Maybe some people think that, hey, there's a panic to get in here and buying these options at these underlyings at these levels, so the market's really going to rally. I don't really have that feeling right now. I think some people are jumping in a little late and there's going to be a pullback. So that would be my thought. So this fits with my portfolio because it gets me some of that long delta exposure in the underlying. Being, I'm short deltas in the front, but I have more deltas long in the back month. As you can see, you'd be selling, say, a 13, and then you're buying something that's like a 25, so it gives you a little bit long deltas. My overall portfolio is short deltas, which means I'm either long puts or I'm short calls, and I need to add some long delta exposure so I can participate on the upside more. So these fit my book perfectly. Does that make sense? All right, good. Does anybody else have any last minute questions for you? So the ones I'm going to be looking at doing for this is I was looking at Southwest, Microsoft to do, and I think I had one other. Oh, GE was the other one I was looking at. So look on Monday for be talking about these, because I'm thinking I'm going to do GE also, because it has really low, maybe even Facebook. I didn't realize Facebook had such low implied volatility, but look, 10% implied volatility. So watch for Monday on that market commentary that I'll be talking about. All right. So last thing, in the chat box there's a link to this at protraderstrategies.com. You can get market commentaries, which is like I talked about, daily market commentaries, talking about what trades I'm putting on, how I'm defending them, because you got to remember these trades are going to go bad, and I talk about how I'm defending them, when I'm rolling them, the credits I'm getting for them and stuff like that, or debits I'm paying for them. And I talk about geopolitical stuff like Draghi yesterday. I was talking about what they did and what that could do to the markets or whatever. You also get the trading lessons videos, which are kind of like these webinars. I'm talking about these different strategies, but really quickly just kind of going over them rather quickly, kind of like a refresher down the road, like, hey, you know what, it's just after earnings season, and I want to watch that earnings setup. So you get that, and you get access to the trading workshops, which are these things here, where it goes back and forth with your questions. I look at the stocks you guys are looking at, how that can be worked out through the rules that I'm going through, and how you would set it all up. So I go into much greater detail throughout these when I'm doing that. So that is pretty in-depth, or as in-depth as I think you can get in an hour. All right, so I just want to thank you guys all. Later webinars, we're going to be drilling down on options, options components, how to trade them, trades I find, when and where they're appropriate. If you have any questions, you can reach out to us at Pro Trader Strategies, 310-598-6677, or email us at trading@protraderstrategies.com. Also, like I said, this is the link to the options course offer, but there's an easier way to do it, and that's hit it up in the chat box there and do that. I'm being asked, do I send out trade alerts? When I do my daily market commentary, I do that in the early morning. You can also follow me on Twitter at Wolfman's blog, because like on the earnings trades and stuff like that, I'll throw out when I'm doing those. But in the daily market commentaries, I talk about every trade that I'm doing. So if you guys want to take part in that, then that is up to you guys. But I do tell you exactly the trades that I'm doing and when I'm trading them and when I'm getting in and out of them for a profit or a loss. So hope that answers your questions. All right, that's all I got for you guys today. I appreciate you guys all sticking around on a Friday. And that's about it. If you can't take that, take it easy. Thank you guys. Take care.